Welcome everyone to the 2022 A4S Summit. My name is Martina Tessari and I am the head of Europe at A4S. As you may know, A4S has been working with the whole finance and accounting community and value chain to make sustainable business as usual for quite a long time now. And I'm thrilled to kick off the first day of our summit, which will focus on sustainability and sustainability related reporting. The last few years, and in particular the last year, have seen significant developments in this area across different jurisdictions. And these developments are aimed at responding to the need of consistent, comparable, and decision useful information to enable decision making and the reallocation of capital towards more sustainable outcomes. However, in this landscape of multiple frameworks and emerging mandatory standards, finance teams find themselves in a bit of challenge to navigate. And this session will introduce perspectives from European leaders on recent developments and provide you with an understanding of how CFOs are preparing for the year ahead. And I'm delighted to be joined today by remarkable speakers at this panel who will share their knowledge, their experience, and their perspectives and tips on this topic. So they are Wim Bartels, members of the Sustainability Reporting Board of EFRAG, the European Financial Reporting Advisory Group, which was tasked by the European Commission to develop these sustainability reporting standards to be used in the European Union. We've got Magnus Billing, Chief Executive Officer of Alecta, who's a Swedish asset owner and one of the largest pension funds in Europe, who will bring us that perspective from an investor side. And of course, Hilary Mattsson, Executive Vice President and Group Chief Financial Officer at Schneider Electric, considered to be one of the most sustainable companies globally, headquartered in France. And I'm delighted to have you all with us. Welcome you all. So I'd like to start with Wim. Wim, could you give us an overview of the aim of the European Sustainability Reporting Standards, also called the A4S, and the latest development following the public consultation that was run in the summer, and what's coming next?
Yes, sure. Thank you, Martina, for opening up with that question that creates a lot of challenges going forward. I think the ESRSs have been released to the European Commission on the 22nd of November, and they cover 4 social topics and 5 environmental topics, as well as 1 governance. And all of that is in the context of the wider Green Deal of the European Union, of which disclosure requirements are a significant part. And to your question on what is the aim of all these standards, that is really to create an harmonized approach, first of all, across EU companies or companies that operate in the EU. And with that, to inform other players in the European economy, including the financial market participants, about not only the status, but also the progress of us as an economy towards a full sustainable economy by 2050, as is the EU's objective. And not only in terms of addressing the impacts, but also in terms of addressing the potential risk and opportunities, and therefore the adaptation to that changing environment that we're in. So the overall aim of the ESRS is, as I said, can be or maybe will be a challenge because they will be extensive. We have, for example, identified 50 disclosure requirements in terms of indicators that companies would need to report on. Any company would need to report on, and then we have many others that are subject to materiality. So yeah, a challenge, but also important, I think, on the way to sustainability.
Thanks, Wim. That's very clear. Magnus, from your perspective as an investor, do the ESRS and the adoption of the ESRS benefit your investment decisions? Do you think they will make a difference to that reallocation of capital towards sustainable outcomes?
Thank you very much, Martina, for arranging this and having this discussion, which I think is very timely and very important. And the short answer is yes, I do think so. Just to give you a little bit of background on what we are as an investor, because I think there are many different types of investors out there. But for us at Alecta, we try to take a broader perspective on the investments. We're basically looking for a company that is in the long term providing a business model that is to some extent future-proof and thereby capable of delivering shareholder value over time. Now that's a sort of a qualitative assessment in a broader sense, but having said that, obviously we need to have in this fundamental analysis robust, reliable and comparable data. And I think the regulation there can support us in achieving that, because if you go back a few years, I think the development has been positive. The ESG data has matured to some extent, but we haven't got to the point where we can actually sort of feel confident that the data in all aspects are reliable, comparable and robust. So therefore, I think this ESRS can provide added value to us as an investor. I mean, in this investment process, we're always looking for, what impact does ESG factors have on the financial outcome? And we can talk about the short term and the long term. And I think that in particular in the short term, the harmonization and standardization that is coming now will support and improve investment process. And also, I think, end of the day, allocate more capital towards ESG investments. So that's very good, and that's something I very much support. I think there's also a need over time to calibrate these regulations as we move along, because there's always a risk that you harmonize and standardize too much. Just looking at the European landscape on who are the ones that are creating jobs and value over time. That's a number of SME companies in Europe. And there's a burden for them to manage this, obviously. So there you need to have a calibration. I also think we need to have a calibration over time to ensure that we don't hamper innovation by standardizing too much. But net, I'm very positive towards this regulation. And I also think when it comes to mandatory part, I think it's a good step to take. I think as an investor, we will take on the mandatory aspect in different ways, whether it's benchmarking or where it's selection processes as such. But I think mandatory feature is one factor that would support the robustness, reliability, and comparability in the data going forward.
Thanks, Magnus. That's very interesting and well said, and very good to hear also that calibration point you've mentioned. And then going to Hillary, well, actually, of course, not an SME. She leads in there. Schneider Electric have been reporting sustainability information since, I believe, 2006. So Hillary, from your perspective, will the ESRS change a lot of what you've been doing? What are you pleased to see in there? What are the biggest challenges for you? What needs to happen?
Yeah, thanks, Martina, and happy to be here commenting alongside Women Magnus today. Like you correctly said, Schneider has been reporting sustainability information for 15 years, so we consider ourselves somewhat advanced in terms of the topic, although obviously still more to go and more to learn. Also, we're listed in France, so we've been subject to more stringent requirements for that market already. So for instance, under the current European regulation, the NFRD, or the Non-Financial Reporting Directive, audit's not mandatory except in France, where they took a different approach. So we're already audited there, and we're already disclosing in our regulated annual reporting our main climate-related disclosures in line with the TCFD, again, more in the French context. Nevertheless, even for us, we think this ESRS will trigger significant changes to reporting, definitely for all companies, and again, including ourselves. And for the reason for that we see as being the level of complexity of the requirements in terms of quantity of information to disclose. I think Wim already mentioned something like mandatory 50 KPIs, plus a bunch more, depending on materiality. The expected granularity on those is also pretty high. And currently, from our perspective, we're not quite there yet. There's a lack of clear definitions or methodologies to apply. So from our perspective, very aligned, super pleased that regulators and governments are really seeking to create transparency levels that from our perspective should enable investors to better understand how companies are driving value and managing risks for the longer term. But we should realize for a lot of companies, this regulatory framework don't have the baseline that Schneider does, so will come as a big bang and bring with it a lot more reporting burden and cost for some time, potentially without yet bringing the clarity and transparency for investors that's desired. Although again, I think it's a journey. Another challenge we do see is the consistency between the European regulations themselves, such as the European Green Taxonomy and CSRD, as well as the interoperability with ISSB and the SEC regulations, or even national regulation on top of the EU. And I gave some comments about how France is different, that could lead to varied reporting and some confusion among companies and investors. So I think it's a good journey and one that hopefully all of the players will take together to make it work.
Yeah, and Hillary, if I might, because I very much recognize the challenge of interoperability, as you just said. When we released the exposure draft back in April, that was, I think, honestly a key issue. In the work up till to the release of the final draft, we did look into the alignment with the ISSB. So at this moment, it is mostly aligned. There are a few points that I can maybe talk on later, but mostly aligned. But it is also, as you said, a challenge with other EU regulations, and a check had been done, and that's, for example, why we ended up with this 50 indicators, because, for example, in the SFDR, there are indicators for the financial sector, so including Magnus, that we need to have from the non-financials. But it comes, as I think you said, with the burden for you who are long in this journey, but also for all the other large companies in the EU. And we will be developing further sector-specific standards in the next year for 10 sectors initially, then another 10, 11 in the year after, and then the final up to 40 in 2026, as well as listed SME standards. So that also SMEs have a kind of a guide. For listed, it will be mandatory. For others, SMEs, it will be voluntary. But I think honestly, we can expect SMEs to look into that. And we should not forget also that we will also see further standards also to be developed in the next year for non-EU companies, so companies with large operations or revenues in the EU. So the impact of the standards are much wider than even only the EU region. And I think that is important to note.
Thanks, Wim. And I guess in that landscape, you both touched on interoperability. And so that is absolutely key to ensure that not just this provides the needs to investors, the information needs to investors to kind of be able to compare performance of different organizations, but also really make the life easier to reporting organizations as well. So Wim, I know you've mentioned, how much work has been done in the last few months just to kind of push that interoperability, in particular with the ISSB standards being developed there. What are the main differences that remain? Can those be mitigated? How much does the agenda of the European Union, political agenda of the European Union, play a role in this?
Yeah. Well, maybe first then we should start with with the scope of each set of standards, right? So the ISSB is really focused on the primary users of financial statements, or simply said, investors and creditors. And whereas the EU has a broader group of stakeholders, right? That they cover essentially all material stakeholders for a company, and that is a difference in terms of scope that drives also the differences in content of the standard. So where the ISSB focuses only on financial materiality, the ESRSs or the CSRD focus, as I think many of you watching today know, on double materiality, also on the impact of a company on the environment. Now, within the ISSB, there's also this discussion about what impacts will ultimately create a financial risk or opportunity. So there is definitely a link between the two, but principally ISSB ends with financial materiality, and EU, as said, has a broader scope. Then naturally the scope of companies is much broader. So and different for the ISSB, it will be the companies that apply IFRSs. For EU, it will be all large companies in the EU and a number of non-EU. The time horizons are a little different. So that's to say, the ISSB provides full flexibility on the time horizons. The ESRSs start with defined time horizons, the 1 year, 1 to 5, and then more than 5. And you can deviate if you need to, but default is standardized time horizons. And then to your point, will we see political influence? Yes, definitely. So, for example, the EU proposal, or the proposal to the EU, is now to have climate change mandatory for all companies. We can expect within the ISSB that also there it will effectively be mandatory, but principally it starts with full materiality. So if you would conclude that climate change would not be material for your company, you would not report against that standard. In the EU, that will be mandated expectedly, as we proposed. And then within that standard, we have some additional requirements that are related, I think, to your point. So, for example, the ESRS asks for a transition plan against 1.5 degrees. That's purely politically driven. The EU asked for the taxonomy indicators that Hillary already referred to, and that is politically driven. So this political influence we will definitely see within the ESRS, but ending back with that interoperability, we have agreed to align as much as possible to create a common baseline and to therefore fully align between the standards. We will see a timing difference. So at this moment, there is alignment or interoperability. The ISSB standard will be updated. That may come with changes. We can expect it to come with changes, and then we need to do another round to make sure that we also stay aligned in future. But all in all, really interoperable is the objective.
Thanks, Wim. I guess that's very reassuring. And also, from my understanding, the aim is to avoid double reporting as well, so that when organizations report under the ESRS, they don't need then to report or create a separate report under the ISSB. So that's a key point to note. But back to your point around double materiality, which is very interesting in terms of the lenses where this is approached. I want to go to Magnus now, being an investor, of course, so that kind of, how does double materiality impact him, or is that kind of like single materiality or financial materiality different? You know, Magnus, earlier this summer, you, together with other investors convened by A4S, signed a statement to the ISSB calling on that global alignment, but also highlighting the importance of that double materiality approach to really support your investment decision making. So why is it important for investors?
Well, I think the double materiality has sort of emanated from sort of environmentalist and other stakeholder groups pushing the financial community, and rightfully so. What the investor community has done in the past few years is trying to translate that into financial risk into their investment process, I think. But coming back a little bit to my earlier point about the short-termism and the long-termism, I think where we are right now is a little bit too much focused on the short-term risk, because the impact on people and planet, the double materiality component, is more long-term, and we haven't sort of fully translated that into financial risk, financial opportunities into the investment process. So I think putting this into regulation, standardizing and harmonizing will support us in sort of catering for the more long-term perspective on the material impact on people and planet. So I think that's a very good step forward, and a step that I very much support. Having said that, I think obviously there are challenges with this, because how far in the value chain can you go in a reliable way, in a quantitative way, in a detailed way, in a robust way? How much of the life cycle analysis are you capable to do as an investor? But I think the direction is the right one, and then you have borderlines that I think needs to be a little bit considered. And I'm sure Hillary can relate to this, but my feedback, the feedback I get from corporates that we invest into, that this is quite challenging in the reporting perspective. But I do think it could support also innovation within the corporates. So just one concrete example is that when you see companies within the battery production area, for example, you see when they go through the value chain and the challenges they have there, impact on people and planet is obviously coming up, which has, in some instances, moved the innovation towards battery production based on forestry and wood, which is quite exciting, I think. So there is a concrete example of regulation actually pushing innovation in the marketplace. I think having said with this as a basis, I think a stage process is something that I would like to argue a little bit for, so we don't overload the double materiality aspect of material impact on people and planet, but we take this as a step by step. But I do think that's the right way to go again, and I think it would benefit us as an investor to make a proper investment analysis and decision going forward.
Very interesting, Magnus. I mean, kind of like really being able to translate that kind of non-financial aspect of materiality into innovation, and therefore linked with a long-term financial results in the end. So that's very interesting. Thank you. And then Hillary, of course, Magnus called on you, to talk about double materiality. What's your perspective on that? You've been reporting under double materiality for a while. Is this going to change? What's the role of the finance team in this process?
Okay, so double materiality, a tricky subject in my mind, and one that frankly, throughout the course of these dialogues over the last couple of years, definitely points out to me that I am not a regulator. But to give you the Schneider view, if by double materiality, we mean additional reporting, in some sense, this is true that Schneider does quote double materiality. We publish both sustainability reporting. We have what we call our SSI index, which is tied to our bonus within the company, which is the key set of goals we're looking to drive over a 5-year time period for our company. We also report extra KPIs under what we call our SSE, together with our financial reporting, and we've done so for quite some time. Finance obviously plays a big role within financial reporting, of course, but also sustainability reporting to ensure robustness, quality. We provide a lot of input data. More importantly, though, finance drives alongside strategy, the strategic planning process for the company, where we look at the opportunities, value, and risk tied to ESG matters and lots of other matters, obviously. But I would say our SSI and SSE reporting today is not linked to double materiality as defined by ESRS or as Wim just explained. Instead, we're reporting voluntary goals tied to the ESG transformation we want to achieve, primarily to create value for our company by avoiding risk or adding value through new business opportunities. So to me, that's effectively this long-term enterprise value approach. From my perspective for Schneider, we advocate for something, and look, I don't care what we call it, but something more like full materiality rather than the exact double materiality, because we do think, and it's been said a couple of times already, we consider all of these points as tied to medium and long-term enterprise value for the company, and all the ESG considerations and impacts we think in a long-term model of your company can be there. Whether it's that you won't be able to operate because of new regulation that's coming into place, whether it's because you want to drive diversity and diverse thinking in your own company for innovation purposes, for example. So we think considering all of this, the impacts of our company on society, the environment, the governance structure we choose behind us, really helps us in developing an effective management strategy, as well as then reporting, obviously, on all of that, both on internal and external issues to our various stakeholders, so they can understand whether, in fact, we're going to drive medium or long-term value. So for us, we do think the convergence over this materiality concept really is important, and should take into consideration short, medium, and long-term impacts on enterprise value. Well recognized there's some political interests in the ESRS, but we really believe that this should be able to come together in the concept of materiality tied with enterprise value over the medium and long term for companies.
Very interesting, Hilary. I think it really summarizes very well the links between the two aspects under a common one definition. And, you know, we touched just now on the link between, let's say, sustainability information and the financial impacts of those aspects. And there are detailed examples in the ESRS that require that sort of information, that connectivity with financial information. For example, one of the requirements is to calculate the financial impacts of climate risks and opportunity. So Wim, can you tell us a bit more about this aspect? Why is it important for the regulator?
Yeah, well, I think it links nicely back to what Hilary just explained on the full materiality. I think, Hilary, you called it rather than double materiality, but particularly that longer term perspective and what that means for the financial thrivability or the financial position and development of any company. And I think, as Hilary, you also believe ultimately any major impact of a company will result in financial effects that can be both a balance sheet and P&L, but ultimately, of course, the value of the company. And therefore, where the EU included the risk and opportunities, it is to make that link to the sustainability of the company itself, so to say, so the continuity of the company, in light also of adaptation to that new economic reality. So be it to invest in new types of assets, new type of products that come with maybe a lower profitability and or an opportunity, be it in the value of your assets that may be at risk because your current business model will not work on that longer term horizon, or because you want to do or you need to invest in measures to mitigate the impact you have on society still, and again with the same objective that Hillary, I think, so well explained. And therefore, the EU is looking for that connection, and also to make sure that if an impact will have ultimately an effect on, for example, the value of assets, that's been properly reflected in the financial statements, that if a company, and that to take climate as an example, but it applies to the others as well, that if you face a risk, for example, because you are in the food industry and you source from areas that come at water risk, that has been reflected, so that again, in this case, investors can take the right decisions for these companies, and also the management reflects well what their perspective is on the future of the company and how that relates to sustainability. So the EU sees a direct link, I think rightly so, between ultimate value creation and sustainability, or the other way around.
And then, of course, this links well with my question to Magnus. How important is this? And I presume investors already take these aspects into consideration for their investment decision making. What are your perspectives?
Well, it is important. I mean, what we're looking for is to invest into a business model that is capable of, as I mentioned earlier, to deliver value in the long term, i.e. a business model that is sustainable or viable in a net zero society. So that's the kind of business model that we're looking to invest into. Either it's already close to getting to that point, or it's a transition case, which should hopefully create a lot of value for our customer, our beneficiaries down the line. So that's the forward-looking part of it. Obviously, connecting it to the financial is therefore very important. I think maybe more important on the risk side as an investor rather than the opportunity side. I also think that there's a perspective here of forward-looking and backward-looking. A lot of this financial data point is, at least today, very much backward-looking, and that has a value. But we are more interested in the forward-looking part of it. What are the transition games or transition plans and transition pathways that could be able to create value going forward? And that's even more challenging. And we've seen that in the past few years to get that reliability, robustness in the forward-looking part of it. I think there's steps to be made. I just look at how we sort of work with our portfolio on its entirety, where we try to internalize as much of externalities in the climate space as much as possible by putting in scenarios on different CO2 prices. And we can see today how significant the impact is on the value of the assets in our portfolio. Obviously, I mean, it's not only negative to see that, it creates opportunities to have an engagement with the corporates about what's the adaptation to the business model to cater for this discrepancy between the value in the marketplace compared to what we see when we stress test our portfolio based on scenario 1.5 degrees on the CO2 price. And that engagement we have seen in the past few years creates a lot of good output that is value creating over time, I think. So different aspects of this, but the connectivity, yes, it's important, but it's not the silver bullet.
Mm-hmm. Thanks, Magnus. And it sounds like a lot of work has already been done from the investor side on this. And therefore, Hillary, from your end, of course, you mentioned earlier that kind of full materiality and the connection that is, of course, you're already looking at from Schneider Electric. But for many organizations, this will be new. Magnus mentioned, that forward-looking element. How will company needs to get ready for this granularity of information, and what should finance teams do to tackle this challenge?
Sure. So we're quite lucky, like we talked about before, that we have a baseline established. So where are we today, right? With a climate change and full set of ESG targets we've been pursuing and reporting on for some time. That's really the key first step that would need to be driven across an organization that's new to the topic usually, particularly with the small and medium enterprises, perhaps with finance leading or partnering with others, strategy, sustainability, depending on what kind of leadership team that you have. But really, you can't create you have to understand where you are today. That's probably the biggest key. For us personally, even though we have been reporting from some time, the CSRD is a new level of granularity. So we've created a new sustainability reporting position, VP position in finance, just in September of this year, who will be the global leader in finance to structure and coordinate that monitoring and reporting across Schneider, as defined by, of course, finance is not expert in the real details of sustainability, particularly when it comes to the climate side, where there's a lot of science and a lot of work that needs to go in there. So like we do with financial reporting, we'll work with that sustainability team to make sure that we're defining things correctly, adhering to the regulations, and then eventually doing the reporting. Probably big objective is ensuring collaboration, therefore, across finance, sustainability. We have a data governance team, strategy team, to really ensure our capacity to provide that information and on a timely and credible basis. As of today, for us, the priorities are the application of the green taxonomy, as well as the climate disclosure requirements from ESMA, as well as we have the French regulator AMF also, who has additional regulations. And then on top of this, we've also launched some internal initiatives to boost our own transition, because I think that's really probably the real purpose, right? As opposed to creating reporting. So to that end, starting from 2023, we're doing things like measuring the carbon footprint reduction in our R&D projects, as well as our other individual investments. We'll communicate and fix carbon footprint targets for our travel and real estate. The idea is to embed that CO2 criteria in our financial tools and processes, and into our strategy, so everyone in the company can understand how they're playing a role. We're not yet leaping to guessing on CO2 pricing in the future, as Magnus just spoke about, but with the CO2 reporting in finance, we can run a lot of scenarios with different levels of CO2 pricing in the future to better understand what we're doing across our organization and what value or what financial impact that it could have. Still a lot of work to do, but for me, finance really plays that key role between, these are real things that your organization has to do. So making sure that we understand what we're doing in the organization itself through the internal reporting side and internal process side, tied to then this quite extensive amount of external reporting that also is coming on us now in 23 and 24.
Yeah, thanks, Hilary, and very key. You've just touched on the key role of finance in really embedding everything into the whole operation and business model. So thank you for that. You've also touched on, there was a word that I captured that was that kind of credibility piece, that finance brings. And this links really well with the requirements of CSRD around assurance. CSRD is asking reporting organizations to undertake limited assurance over non-financial information with the view to move into reasonable assurance at a later stage. So this is a very game changer, I'd say, for many organizations who so far haven't necessarily undertaken assurance on this sort of information. So Magnus, from your end, why is assurance so important for investors?
Well, I think it comes down to standardization, harmonization, and robustness, and comparability, and the credibility that the insurance brings to that field is valuable to any investor, I would argue. Then I think, at least for us as a investor who believe in fundamental analysis, there will always be, we will always look for possibilities to assess make our own assessment based on other type of data that has not been insured. But I think looking at it across the board of the investor community, I think it would bring a lot of value. And I think hopefully we will see more capital being allocated towards CST investment opportunities as a consequence of that. So it clearly provides a value to the investor community.
Yeah, absolutely. And Hilary, from your end then, given you've mentioned earlier, you've been assuring information for a while now. Do you have any tips, any learnings from that experience you want to share with reporters to help them with that exercise as well?
Indeed. So we've had all of our SSI and SSE programs audited annually for some time. This means for us more than 30 KPIs, as well as the majority of our environmental data. So across water, waste, energy, our entire carbon footprint, the scope 1, 2, and 3, HR data, and health and safety information. In 2022, we're actually increasing the audit level to reasonable insurance for the energy, CO2, gender diversity, and safety indicators, while the rest of the KPIs we have at the moderate assurance level. I think on the positive side, and we've mentioned it a couple of times already, the assurance ensures the credibility of information we're making available to the relevant stakeholders. Particularly for us, we have quite a number of the KPIs that are linked to our employee remuneration. So either our long-term or short-term bonus schemes. Of course, however, this takes a lot of work, particularly at the beginning. So for other reporters, I would say don't underestimate the amount of time and the amount of resource it will take at the beginning. Of course, like all auditing, we think that over the years, the auditors' questions have really strengthened our internal processes. They challenge our methodologies, they challenge our ways of reporting, and we do better over time together on that. And of course, from someone like my perspective, CFO, I have to sign off on a lot of things. The assurance protects us probably against just basic reporting errors or also accusations of greenwashing. One point I would make is through the experience of implementing the NFRD in France, here we probably faced a lack of clear guidelines on audit expectations and outcomes up front, which makes the first few audits for companies very, very complicated and for the auditors themselves. So we hope this time to have very clear rules and expectations from the auditors. And for that, obviously, they need clarity in the regulations before the first year of application. Otherwise, I would be concerned that there will be huge pushback as the EU wants to try to get this into place, because if it's not manageable.
Thanks, Hilary. And we are aware that the IAASB are working on specific standards on this, so that will hopefully fill that gap you've just highlighted. But Wim, you're also a partner in a large audit firm. So what happens from your side? What needs to happen to make this very effective, and how will you get the resources and knowledge in place? Because I guess the transformation is very significant.
Yeah, well, talking about challenges, this is one. I think in general, the audit profession has a kind of waken up on this upcoming assurance requirement. So I'm also a chair of the Sustainability Policy Group at Accountancy Europe, which brings together all the auditors across Europe, and we are heavily discussing here, amongst others, our interaction with the IAASB to make sure that we have a common understanding of what needs to happen, right, in terms of the standard. As I think Hilary was also alluding to, is the expectations from the auditors, but also the expectations maybe by the auditors, and we need therefore to further calibrate. So what I understand from all the large audit firms, which is more than the big four, huh? So it is, I think, big 8 or big 10 or so. They are all now investing in getting the knowledge up to speed, training programs to understand the topic. And I think to what Hillary said earlier, like auditors challenge you on the processes and the methodologies, etc. First of all, that comes with a real good understanding of the topic, right? So it is not just some data from a process. You need to understand what you're talking about. So we see also adding further specialists that we had already, and that was mainly, I think, in the Big Four, to be honest, the specialist departments with sustainability practitioners who now are added to the teams, not to take over, but to add that specific knowledge and make sure that all the auditors get up to a certain standard. But I wanted to highlight also one other point that also, Hillary, you said, is the risk of greenwashing. And the risk of greenwashing does most of the time not come from the data, but it comes from the information about the data or the claims you make on the basis of the data. And that's where the auditors also need to really step up and understand what it means to look into text. I can talk for the own audit firm that I'm a partner with. We are indeed training our people across the world. We are setting up methodologies to sharpen it, and we are installing technology to assist, not to replace the audit. So that comes also, for example, to that risk of greenwashing and looking into the sentiment, if you like, of reporting rather than the factual data elements, and then also adding other specialists from our team. So, for example, from technology or from controls and governance, to make sure that we capture all the different elements. Finally, to your point on resources, that's where the real challenge is. So there's so much demand now for people who understand audit and ESG that we are, I think, we're investing a lot, but also somewhat desperately looking for all these resources. And, it is what it is. We can't solve it right away. The best we can do is to integrate it into the knowledge of the current auditors, because I think that's the best lever, if you like, to get this to an effective process and not overburden the likes of Schneider Electric.
Thanks, Wim. I think that highlights, of course, the significant efforts from the audit profession as well, in terms of upskilling, but also investments that you highlight there. So thanks for that. Well, we're almost up on time, so I'd like to raise a final question, first with Hillary and Magnus. In particular, you've been talking about, we've been sharing tips all the way up to now. But what are, from my end, the questions to you both, what are the two main things that companies or investors indeed could start doing today to get ready for the ESRS when they will finally be adopted, and to prepare for that assurance under the CSRD rules? Should we start with Magnus?
Okay, thank you. I think we have just recently sent out to the board, the chairman of the board of directors in the 100 companies that we own equity into, with a message that is basically, we think the goals and the disclosure of the corporates of your corporate for the specific chairman is good. Now is the time for execution. And that's what we will be pushing you for going forward. Execution, delivering on these goals, continue the disclosure, aligned with what you set out. And I think there are three themes that are coming up on execution. Is we would like to see, do you put sufficient resources in place? Do you have sufficient competence in place? Do you have the right incentives structures to incentivize your colleagues and management team to actually deliver the goals that you have set out for yourself? So I'm quite optimistic today on the corporate side. I'm more concerned about other stakeholders that are necessary in order to deliver the net zero. And that is on the policy level, it's on the local authority level when it comes to permissions and processes around setting up infrastructures, wind farms and so forth. I think the corporates understand what they need to do, and I think they are seeing, that this value possibility in this transition, there is more money to be earned. So execution is the message that we send into the boards.
Thanks, Magnus. Hillary?
So I think, so agreed on those. So sort of execution-wise, first and foremost, we suggest companies think about ESG overall as part of their strategic planning process and tied to business opportunities, probably prior to then layering on the risks. We really believe that many, if not all of the aspects of ESG can be tied to creating medium and long-term value, whether through things like energy efficiency, differentiation in your products, diversification of workforce. I said earlier to drive innovation, but also avoid systemic risk. And secondly, then we would say companies don't underestimate the need to start early to organize a strong governance with the appropriate team, usually across finance, strategy, data, governance, with the right data available around it. You really need a strong baseline of where the company is today. You need to identify the relevant data that you need there through the strategic discussions, harmonize it, because data, unfortunately today, probably for all companies, all of that data comes from different sources. Determine some kind of digital tools to help you automate that and implement the right level of controls over that data. So no doubt need to start now to prepare. I presume most companies have already started that, and make sure you have the right level of resources to implement this level of reporting. The complexity remains very, very high in the reporting today. So it's super important not to underestimate those resources that will be necessary to get there.
Thanks, Hillary. Well, a clear call on kind of like focus and action there in terms of getting ready. We touched on granularity, we touched on data now. So Wim, what do you see as being key to ensuring that reporting under ESRS does not become a compliance exercise, but actually really drives forward that kind of provides that decision useful information and drives forward, progress towards a sustainable business?
Right. Yeah, I would merely echo, I think, both the words of Magnus and Hillary, and in a sense of build up the competence, the understanding, and link it to the strategic process and performance management, so that I think overall is the right approach to go beyond just compliance. Practically, I would suggest two things. I think one is don't make this a sustainability department exercise, as I have seen for a very long time with sustainability generally to date. It is an exercise of all departments that Hillary already named. Secondly, take the output from an ESRS analysis on what you need to do as input for the strategic and performance management cycle, and separate between those disclosure requirements and indicators that really matter to your business. They will be limited number, maybe 10, maybe 20, but if it's 30 or 40, I think you may redo the exercise. And all the rest, we should acknowledge you have to do. It is, it is required by the standards, but I would separate them out and take that part as I need to comply, and the core part as this is where I can really make the difference. So that would be, in my view, the practical approach to take. But really output ESRS as input strategy and performance development. That would really make it effective. So all in all, a big opportunity, I hope, from this reporting requirements.
Thanks, Wim. Thanks. I think we've all agreed here that without the right information, neither businesses nor investors will be able to make fully informed decisions. And of course, in determining what disclosures are required, the focus needs to remain on enabling action. Reporting is a means to an end, not an end in itself. So I think this is a clear message that I heard from you all. Unfortunately, that's all the time we've got today. So thanks all very much for sharing your insightful perspectives. Today we heard how on one hand, finance teams must start immediately to get their house in order, looking at governance, control environment, data, strategic planning, but also really tackle the practical challenges around that data accuracy and completeness. And on the other hand, standard setters should focus on achieving as much interoperability as possible to meet meaningful stakeholder information needs, to drive that action, but also to avoid diversion of companies' efforts into reporting instead of action. So for those of you watching, these sessions will be available on demand as soon as the broadcast has ended. Please do join us later today to hear from standard setters around the world, as well as a deep dive into the US reporting landscape as well. So stay tuned and thank you and goodbye.